Okay, we'll start off this week just right at rates and yields because, well, there is no data, but we are getting a data point this week. We get CPI. And we get some 90, 80, 90 companies reporting earnings. I'm just talking about the S&P 500. There are more companies reporting earnings outside of that. Yields, rates and yields all pull back modestly. I wouldn't say that we had some really big moves. As of Thursday night, going into Friday at 6 a.m., yields were much higher. Market was down 70 points, and all the way through Friday morning on Bloomberg, you heard the market talk itself out of any kind of problem. Not that any problem was solved, you just heard them slowly talk themselves out of it. From being down 70 points to by the time we opened, we were positive. That even though nothing had changed, just the power of narrative. Oh, this is really bad. Well, it's not really that bad. We've seen worse. It's really kind of okay. It's sort of isolated to here. It's really not much of a problem. I don't think there's anything stopping us from going up. That's how over 2 hours, you just saw the market improve with nothing fixed. Just, let's just ignore it. So yields and rates would have had a better Friday if they had opened the way they felt at 6 a.m. I have said this many times. There was a time when you could look at the market the night before, you could look at Globex and you look at futures and you had an idea of what tomorrow was going to look like. Not anymore. Nothing matters. Nothing matters until the Americans show up because they have this ability that I am in absolute awe of, this ability to ignore absolutely everything. And I think that's what happened on Friday. I'm going to show you some stress that's building in the overnight market. And we'll look at a few other things. Something that happened in the cattle sector and gold and silver. So we have FOMC on October 29th. We are 10 days away. This is going to be a busy week, by the way. The next week is the more critical week. You have a pre-meeting in Malaysia this weekend between U.S. and Chinese representatives that will set the stage for a potential meeting between Trump and Xi in Korea, the 26th to the 1st, somewhere within there, to see if there is any kind of de-escalation to the U.S.-China, a little bit of an escalating potential trade war to begin November 10th. And for our AI corner this week, we'll see what DeepThink thinks about all of that. That took about 12 minutes for DeepThink to think it through. October 29th, 10 days away. Look at this decision tree. Zero. No probability of zero. All the weights on the 25, 99% on the 25. But look what we got showing up this week. 1% probability of a 50 basis point cut. We do have some weight on that. Now, I don't know that that's serious weight at all. I think it's probably just positioning, and you go, half a basis point this way or half a basis point that way, it could change. But there we are. There's a 50 showing up with 1%. I think that bears watching throughout the week to see if that creeps up to 2 to 3 to 4. But there it is. Canada, we're open for business. We have PPI on Monday. We have CPI on Tuesday and retail sales on Thursday. Let's see if any of this can help the Canadian dollar because it has been hanging out at about 140.5 for some time. Hanging on in the face of some U.S. strength, but really just, underperforming. And Friday, we get CPI. Friday morning, we get CPI. The only one data point that we do get. We do have some other things going on. Wednesday, we have the 20-year bond auction. We'll see how the market responds to that. And Tuesday, Waller is speaking twice. I have a question mark here because they are in a blackout period. What's this guy doing? Is this his confirmation speech? Does he have something in mind? Is he already scheduled to say, I accept this position? Thank you, Mr. President. Rates are coming down. Like, what's going on here? Tuesday, speaking twice. Now, it could be something really benign and I just don't know about it, but I saw him on the calendar for twice. I wrote it down, then it occurred to me, wait a minute, what's this guy doing? Look at the 3-month to 10-year slope, only 2 basis points now. Is it going to reinvert? Where are we on the 3-month? The 3-month is at 4. If we get rate cuts, it's probably already anticipating rate cuts. That'll drop by 25 basis points. 10 years ended at 402. It was below 4 for most of the day. 3.9 something, 3.978, 3.98. But here we are, 402. Look at this. This is building. Reverse repo is down to 4 billion. Reserves just under 3 trillion here. 2.988. The TGA's at 851. That's the target, by the way. Besson set an $850 billion target for the TGA. There it is. But they're not spending any money, so of course that would begin to build. Repos 6.75 billion. Going into the weekend, hit 8.35 billion on Wednesday at a fairly high rate. TLT up 0.64 for the week. SPX up 1.7 for the week. Dollar index down. And let's have a look at Fed funds futures. It had a great week, but this is getting concerning, right? You're 4.11 on the effective federal funds rate now. Last week it got to 410. Earlier in the week it was 409. The week before was 408. It's only 3 basis points. It's well within the 4 to 4.25, but this doesn't move. And here we are at 411. Over a 2-week period, 3 basis points. That's huge. That's huge. Q4 pricing in 53 basis points. That's your 2 rate cuts, I think, this year. Q1, 26 basis points. Q2, 22.5. And Q3, nobody really knows. Maybe, maybe not. And this is all without Trump. So this, to me, seems wrong. Same with this one. It seems kind of wrong. 114 basis points, 4.5 cuts. Here are all your meetings. You have 8 meetings. And Powell is done here. So you got 3 without Powell. We're probably going to get 2 of them here. And if you want to be favorable to Powell to say that he gets to neutral, put 1 there. There's 3. You telling me there's only 1.5 in between here? Don't think so. Just don't think so. October ZQ 9707, implied rate 2.97. I'm thinking 2.25 is probably the target, maybe even 2. But let's say 2.25 or 2.97. So another 90, another 72 basis points off that, I think, as the minimum. And that's assuming that shit doesn't hit the fan in between now and then. That the credit issues that we've been seeing are just, in fact, what the market convinced itself of on Friday morning. Oh, it's a one-off. And one of the smartest people that ran the Fed, Ben Bernanke, I say the smartest because he was sort of the leading scholar on the Great Depression, did not see the subprime mortgage crisis coming. He believed, and he said in Congress, it will be restricted to its own little space. Oh, it's just one fraud. It's a one-off. But Jamie Dimon said, where there's one cockroach, there are many. And every pullback has shown that fraud is never just in one place. When the dot-com burst, Enron was the tip of the iceberg. You had WorldCom, Adelphia. You had a whole bunch. Suddenly it was like it was everywhere. When the housing the mortgage-backed security bubble burst in 2007, you found fraud everywhere. And here we have one fraud. Oh, it's contained. That's all it is. It's only one. It's nowhere else. It's nowhere else. Human nature only existed there. You see, if you have a business and you need cash and the cash isn't there, you have to come up with liquidity somehow. And human nature being normally distributed, it's not concentrated. It's not as if the people who are willing to cross the line were concentrated in only one business. They are spread across all the businesses, and there are lots of people willing to cross the line and say, well, what if we did this? We could at least, bridge the tide. We can get over to this point. Maybe something better will happen at that point. But if we just pledge these assets to two different sources, we might be okay. We might be okay. And maybe we can keep doing that. Borrow from Peter to pay Paul. And if we can kick the can down the road for a while, things might get better. Are you telling me it was all concentrated in only one company and only one company did it? No. So if we start peeling back some layers and we start seeing more of that happening, then yeah, my ZQ will perform very, very well, and I think 2.25 will just be table stakes at that point. Real yields, absolutely no change, only on the 30-year. So I had to go back and say, well, I must have done something wrong. It can't all just be zero. So I checked again on the 10th, and they were all right. I checked again on the 17th. I thought, Now, they did change in between there, but I thought, I can see one of them, ending right where the week started. But look at that. The 5, the 7, the 10, the 20 all ended right where the week started. Even the 5-year forward on the calculations. Like, well, we got to give 1 basis point here if we want this to be zero as well. Zero's right across the board. So all of it translated into break-even rates. Look at them all dropping down on the break-even rates. So we're going to find out on Friday whether CPI supports that. OAS, all of them expanded. This is something you don't typically see, or that we haven't seen for a long time, is all of them moving in the same direction. High yield and investment grade all widening. Now, mind you, this is Thursday's data. We don't have Friday. Friday, the market talked itself out of any problem. So I don't know if the spreads tightened on Friday saying, yeah, you're right. There's nothing to see here. It's a one-off. All the bad people were only concentrated in that one fund or that one company. It's a one-off. Mortgage 6.27. Look at that. We're on the 5-handle watch. We're 28 basis points away from a 5-handle. 28 because you got to get to 5.99, right? Mortgage applications last week were down 1.8%, and we have existing home sales that are going to be showing up on Thursday. Let me see if I can move some of these devices further away from me. And look at this. This is the Repo facility. This is as of 10/16. I won't have 10/17 till Monday, but this is as of 10/16. It rarely is this used outside of quarter end periods. And look at this, 8.35 billion at the upper end. Of course it is, because reverse repos happen at 4. Repos happen at 4.25, because that is the target range for the Fed funds rate. If there's way too much liquidity out there, the Fed says, you come to us, we'll give you 4. So that there is no reason why a rate should be below, an overnight rate should be below 4. And if it says, if you can't borrow money anywhere else, you come to us and we'll lend it to you at 4.25, so that rates should not creep above 4.25. So it would clear out at 4.25 because this is the Fed. This is U.S. banks using this, and this is what they've pledged. This was the day before, October 15th, 6.75 billion. October 16th was 8.35 billion. Looking in outside the Fed, this is the Fed's repo facility. Outside of that, just in the repo market, general collateral 4.36. That is 11 basis points above the 4.25. They can't go to the Fed here. So general collateral 4.36. SOFR sitting at 4.3, which is 5 basis points above. And this is SOFR. This is secured overnight financing rate secured by U.S. Treasuries, 4.3. You have the effective federal funds rate creeping up. You have the reverse repo almost at zero, and the reverse repo is a measure of excess liquidity. It is saying if you have extra money and you can't place it, you come to us. So there's very little excess liquidity out there. General collateral 436, SOFR 4.3. The Fed's repo facility being used by banks in the middle of a month, not month end, not quarter end, in the middle of a month. A couple of things have been pointed out as the cause of this. You had large Treasury settlements, so you have an auction and you have bids on these auctions, and they were large auctions, and then a couple days later they settle, and you got to come up with money, so money has to be transferred to the Treasury. You had large settlements, 40 billion on Wednesday, 23 billion on Thursday. So banks looking around saying, well, we don't really have very much. Let's borrow against what we have. So they pledge a bunch of mortgage-backed securities, some treasuries, to come up with the money to transfer to the Fed because of what they bought at auction, 40 and 23. Reverse repo is near zero. This is a measure of excess liquidity. And quantitative tightening is still going on. Reserves are less than 3 trillion. It's only 5 billion a month allowed to run off on treasuries, but I think we're still at 35 billion a month on mortgage-backed securities, with only about 15 billion happening, simply because the speed is very, very slow. Prepayments are very, very low. You start getting this mortgage rate into a 5 handle, 5.9, 5.8, you could see the speed start to increase. I'll throw this one away as well. You can see the speed start to increase on the prepayments, which would drain reserves faster, more stress. Look to the meeting. Look to the press conference. There is going to be a question on balance sheet runoff if they don't already bring it up themselves. At least they should have somebody watching this, because we can see it. This is not a problem yet, but it shouldn't move. The thing is, this stuff shouldn't move, and it is moving in the wrong direction. So it is the beginning of a problem. They want to get to an ample reserves regime. My thinking, it's at 2.5 trillion based on reserves and repos. They're sitting about under 500 billion away from that, with about 20 billion a month running off the balance sheet out of 500 billion. I think you'd want to slow that down at this point. So look for them to probably lower the cap on the treasuries to zero, have no treasuries roll off, and maybe lower that cap on the mortgage-backed securities to 5 billion, with anything extra being rolled into treasuries. So bring that down. I think that's probably, we might see something like that next Wednesday, which would really give support to the Treasury market. But this is something I think daily. I know I refresh daily just to see where we are on these things. I have tabs open for the New York Fed, for the reverse repo, for the effective federal funds rate, and for the repo facility. And every day, as the market closes, I refresh just to see how these markets ended. Do a quick update here on gold and silver. They did not have very good Fridays. What I have up are 1 month charts. I think these are 4-hour candles. So the prices that I'm pointing out are the closing of the candle, not the daily closing. So gold, the high on this chart is 43.7890 on a closing basis. It's the closing of that candle. And then you have the closing on Friday, 42.13, down 4%. Silver, 6.6% on big volume. Now, if you're looking at daily closing, it'll be different because I don't have a daily chart up here. I have 4-hour candles. This is just a 1 month chart. But still, the message is clear. It just was not a very good day in either gold or silver. Still, though, year to date, look at this. Year to date, gold is up 61.66%. Silver is up 70%. And look at the volatility. Gold 27.4. That is elevated for gold. Silver 46.4% IV. Pricing out the at the money straddle. This is the November expiration, 38 days to expiration. Pays $5.90. That's about a $29,000 straddle. 11.8% of the price. Almost 12% of the price. This is normally what you'd see on a tech stock just before earnings, is you'd see a spread like that. Silver's trading like a tech stock that's reporting earnings after the bell. So be careful there. If you look at gold, gold has a certain amount of volatility within it. Silver, if you look at it, has a much higher volatility. Even though it tracks gold very, very closely, it does so with much higher volatility. So why the sell-off on Friday? I did a search. I asked Perplexity, what do you see out there? There was already the dollar. The dollar was slightly stronger on Friday, 0.2, but that doesn't explain these kind of moves. Primary factor that it came up with is probably profit taking, which seems to me to make a lot of sense. I mean, silver, especially after breaking 50, runs all the way to a little over 54 that day. At that point, you look at it, you say, well, look, these kind of, this is sustainable. But when you start getting this on a chart, that is unsustainable. So you can draw out like a 200-day moving average on this kind of thing, right? And this is what it would look like. Once you start getting these kind of moves above the 200-day moving average, where you're one standard deviation, then your two standard deviations, suddenly you're three standard deviations above the 200-day moving average. That means only 1% of the time does it stay that way, right? If you're three standard deviations, 99% of the time it's within three standard deviations. You got to start thinking, oh wow, this would be a time to take profit, being that only 1% of the time did this ever work out. So profit taking. Ease of haven demand, I don't know. Tariff down talk, Trump saying, look, 100% is unsustainable, so obviously that's a stupid thing. Plus on Friday morning, the market did talk itself out of any kind of credit concern. It didn't fix the credit concern, it just talked itself out of it. And you can't ignore automated selling. There is a certain amount of automated trading in the market, and if you hit certain trigger points, certain stop points, it will increase the selling. Is this over? I don't think so. I don't think this ends with just one bad day. We have earnings next week, and I don't think that there is only one credit problem out there. It's just a matter of time before we find another one, and maybe even another one. So these will continue to get a bid, I think. And as long as you have this administration, you have a lot of global uncertainty with everything on the table. When I say everything on the table, it even means weaponizing the US dollar. Even that's on the table. So why not continue the diversification away from the US dollar into gold? So no, I don't think it's over. I just think that this is the volatility that you're going to have to prepare yourself for being in these kind of trades. So gold, I still think, is a nice directional trade at some point, depending on this pullback. But you got to get closer to that 200-day moving average. Put a chart up, look at the 200-day moving average and the 50-day, and you can find 2 points of entry, one on the 50, one on the 200 perhaps. Silver, I would probably not really care too much about the directional trade, but you'd probably want to start thinking about, how do I get a piece of that volatility? If anybody had cattle futures on their watch list, you would have seen those big red numbers on Friday. Feeder cattle, limit down. Live cattle, not limit down, but down quite a bit. Feeder cattle get fed to a certain weight, and then they get sold to ranchers, and they become live cattle, and live cattle get to a certain weight, 1,300 pounds to 1,350 pounds, and then they go to packers, meat packers. This is November feeder cattle, limit down 9.25 cents per pound. Often quoted in hundredweight, so you might hear it said that it was down 92.50, down 2.43% to 371.70. Even at 371.70, even after being limit down, feeder cattle is up 44.4% in 1 year. This is not year to date. This is a 1 year chart. In 1 year, up 44%. Well, tariffs on Brazil. You can't send us your meat. Export quotas in Argentina. You can only send us so much. So what do you think is going to happen, right? Live cattle for December. This was down as well, down to 242. Still up 33% over a 1 year period. I will get to the blue writing soon when we talk about the spread. So when you see something like this, you see feeder cattle limit down. Limit down's a big deal. That means it simply just opens and that's it. There's no more trading at a price lower than that, only higher than that. So limit down, there's got to be a catalyst. That's just not some little deviation on some news report. Besides, what news? USDA is the biggest releaser of news in this space, and it's not doing anything. There is no news release. So Thursday, after the closed press conference, the Trump talked about worked our magic. The administration has worked our magic and struck a deal that would bring down beef prices soon. And that was enough for the market the next day to say, holy shit, what does that mean, worked our magic? Maybe a higher imports from Argentina because they are sort of helping out there as much as they can. And Trump does want to bring down prices of things to keep going on that. Maybe a lower tariff on Brazil beef. Right now it's 50%. So higher imports from Argentina, perhaps raising the import quota on that. Maybe lowering the tariff on Brazil, or regulatory changes to encourage herd building. Or could be antitrust enforcement in the beef packing sector. The Department of Justice is investigating collusion to limit slaughter volumes, because there are only 4. They're called the Big Four. It is very concentrated. When you get to the meat packers, they got a lot of power. And if they want to keep margins high, well, you decrease the amount of slaughter, which means the amount of meat going into the market is very low, but the amount of live hogs building up is too many. So you push down the price of live hogs, you push up the price of beef, you increase your margins. Is that what's going on? Feeder cattle up 44, live cattle up 33% in a 1 year period. Doesn't seem like you're increasing the size of the herd unjustly by not accepting them for slaughter. I mean, they'll just stay on feed longer, and when they go to the slaughterhouse, they'll just weigh more, up to a certain point. But it doesn't seem that way. So it's more than likely going to happen here, which means more supply. And if you have more supply, well, that will drive down prices. Look at the live cattle to live hog spread. A year ago, the spread was 110. This has a mean reverting level. These kind of interspecies spreads have mean reverting levels, 110. But it didn't revert. 158 today. And sometimes when it doesn't revert for a period of time, you got to go looking for a reason. Well, live cattle was supported by import quotas from Argentina and tariffs from Brazil. And hogs were held down because the Chinese are saying, well, if you're going to treat us this way, we'll buy our pork somewhere else. So pork cutout exports to China are down 16%, year over year, down 16%. So that creates a glut of hogs in the U.S. So packers are paying less because they don't have the Chinese export market to the extent that they had before. But we do have some changes coming up. If you expect that there's going to be something here, because beef prices are ridiculous, by the way. There's a certain type of loin that I used to buy, mostly for my dog when I had it. And I keep it around sometimes because it's not bad. The last, and I buy them in these large, package sizes from Costco, and then you just cut them yourself, right? Well, the last one that I had in my freezer had a price, I think, of $48 on it. It is $94 at Costco. I picked one up saying I should replace this, and I picked it up a little bit. 94 for this cut. It's not. It's sort of a medium kind of cut. I thought, I'm not paying 94 bucks for this. But look at that price difference. So if you've been to the grocery store to buy steaks, they are not cheap at all. So if you think that while there's going to be more supply, prices are going to come down, then live hogs should continue their price down. China has raised tariffs on the EU for pork. That should help the US a bit, because if you have tariffs on US pork, but nowhere else, China can order from the EU. But if you raise tariffs on the European Union, well, maybe you're indifferent between European Union and the US again. So that should help US exports. So if you get some boost in demand for pork and some extra supply for cattle, what created the spread would cure the spread at 158.65. That is a huge spread between pork and beef. So it might be time to do a spread trade between pork and beef, and they're both 40,000 pounds. So the trade is easy to set up. It is really a one-for-one. Is you would short one LE and you would go long one HE, and you're betting on this spread. It's 40,000 pounds. So every penny, well, when I say 158.65, if the spread goes to 157.65, it's $400. Every penny is $400. So it's still got quite a bit of movement in there, but your margin would be fairly low. I have finished the live derivatives for live cattle, live hogs, and pork cutouts. So let's have a look. I'll just show you the table of contents. This will be up probably by Wednesday. This should be up in the same place in Applied Asset Management under Trading Manuals. There is one that I've started just for derivatives, and I've done energy, I've done grains, I've done metals, and now this is the live sector of the ag space. And I may do the cash crops. That would be sugar, cotton, etc. But let's have a look at the table of contents for the live side. Okay, this one is the longest one yet. It's 128 pages, only because the examples, there are many more examples here, because there are different parts of the value chain that you can trade. You can trade feeder cattle to live cattle. There's a spread there. You can trade live hogs to pork cutouts. There's a spread there. You can trade live cattle to live hogs. There's an interspecies trade. And you can trade corn to live cattle or corn to live hogs. So here's our introduction to livestock market and livestock meat complex. Market structure and value chain. We look at the cattle industry value chain and the hog industry value chain, because all the handoff points are where there is a derivative. Contract specifications, live cattle futures, feeder cattle futures, lean hog futures, and pork cutout futures. There is a product for cattle, choice and select boxed meat, but it doesn't have a futures contract, so you can't trade from the cattle ranch to the packer, but you can trade from the hog farm to the packer. There are tradable pork cutout futures. Seasonality, we go into the types of seasonality, seasonal patterns in cattle markets, seasonal patterns in hog and pork markets, and the analyst calendar, key USDA reports and data releases, cattle on feed, hogs and pigs report, cold storage report, the WASD, weekly slaughter and carcass weight data, and export sales and export shipments. A lot of data. There's a lot of data that comes out, but the market's been blind because that data isn't there. So when you see one of the contracts limit down, it's got to be something, right? Basic directional strategies. Just constructing long positions. The opposite of that is constructing short positions, right? Give you an example here: a long position in live cattle. Another one, a losing trade with proper risk management to show how you would manage your risk in a losing trade. Another one, a short position in feeder cattle. Let's keep going here. We have spread trading, intra-commodity, that is within itself, and calendar spreads in live cattle. There's a live calendar, a calendar spread example. Calendar spreads in feeder cattle. I give you an example, a worked example of that. Calendar spreads in lean hogs. Concept of carry in livestock markets, not the same as it would be in other markets, because of the storage factor. You're storing a live animal here that has very different implications than storing grain, or storing a metal, or storing oil or natural gas. So the carry in livestock markets is slightly different. Example here, a losing spread trade and how you would manage that. Intercommodity spreads, this is between each other. Feeder cattle, live cattle spread. The hork and pog, the lean hog pork cutout spread. This isolates the packer margin. Cattle versus hogs spread, and that's it there. And then we go to the feed to livestock ratio spreads. One, a mean reversion trade. This is the hog to corn ratio mean reversion trade. And then appendices, a whole bunch of sources for data. And when it comes to this space, livestock space, there is no shortage of data. I think it and the energy space are the two with the most amount of data available for you. It's huge. And that is for livestock, the U.S. livestock derivatives table of contents. So there's 4 of them now. One for the energy space, one for the grain space, one for the metal space, and one for livestock. And I may do the cash crops. I don't know. You got to look at what contracts there are and what type of access to information I have for them. But I may do something on the cash crops, and that I think would round out the futures complex. Okay, let's see what AI was able to help us solve this week. I'm going to use Perplexity just to set it up, and then DeepThink to sort of analyze the situation. So for Perplexity, I asked, China and the U.S. are meeting later this month for trade talks. What is the current status of China-U.S. trade? And what are the stakes at this meeting? What is the most likely outcome? Let's go through it here. Current status of China-U.S. trade is tense and highly uncertain. Both sides escalating threats and controls, but also agreeing to resume negotiations later this month. Doesn't sound like a couple that wants to break up. U.S. tariffs on many Chinese goods are still elevated, with a new threat of 100% tariffs set to take effect as early as November. It would, I think he said November 1st, but the 90-day truce ends November 10th, so I think he meant November 10th. Unless China withdraws recent restrictions on rare earth exports. So I think all China is doing is saying, I know you are, but what am I? So the U.S. says, you can't have these really great semiconductors. So China says, good idea. You can't have these real rare earths. And the U.S. says, we're going to charge a fee on Chinese ships entering the port. And China goes, good idea. We're going to charge a fee on U.S. ships entering the port. And the U.S. both times goes, how dare you? How dare you, sir? Yeah. Where are we here? Rare earth exports. China in turn, introduced sweeping controls on rare earth element exports, a crucial input for U.S. manufacturing, tech, and defense, giving Beijing fresh leverage in the dispute. Just to give you an idea of the asymmetry in this fight, rare earths are not really that rare. They are everywhere in the ground, but at very low concentrations, about 150 to 200 parts per million. You need a concentration of at least 5,000 parts per million to be commercially feasible in any world. At least 5,000 parts per million to be commercially feasible. And normally you find them at 150 to 200. So you need concentrations that are some 30 to 40 times higher than that. Well, that does happen. Geologically, it does happen in certain areas. That then creates something called reserves, because they are geologically present in the concentration that you need and economically feasible. So for mining, keep in mind there's mining and refining. For mining, you need those concentrations. Let me just give you a couple of numbers that you need to sit with. Reserves in China, 44 million tons is the estimate for reserves in China for rare earth metals, both light and heavy. The US, 1.6 million tons. 44 to 1.6. So even though the US does have some concentrations that are commercially viable, China is some 25 times higher than that, 30 times higher than that, almost 40 times higher than that, really, in terms of just the reserves, not in terms of how much they've dug up underground, just the reserves. So even if the US did pile into this space, it is a percentage, a single-digit percentage of what the Chinese have. So they just simply don't have enough. And most of it is light rare earths, not the heavy rare earths. That's the difference in mining. The reserve base is significantly lower. Let's go to refining. There is almost zero refining capacity in the US for this. Even the big mine, MP Materials, which has the Mountain Pass mine in California, used to ship its concentrate to China for refining. So concentrate means I dig this rock out of the ground, then I do a whole bunch of stuff to get rid of as much of the garbage that I don't want, to leave nothing but the metals behind. But all the metals are in the concentrate. You have to separate it and refine it. The thing about rare earth separation is they all react pretty much the same way to any kind of chemical separation you use. So you apply a particular chemical and it will get rid of more stuff, but all the metals come along. And you're like, no, guys, you got to separate. So you try another chemical and they all come along. It's like, guys, you're bunching up again. I need you to go this way. I need you to... Separating them becomes hard because they behave so very much alike to these chemical reactions. That's the tough part that China has a far greater advantage over. 90% of all processing and refining happens in China. Think about that for a minute. 1.6 million tons in reserves to 44 million tons with 90% processing and refining capacity, and it will take years to build this out. And even if you do, the US still doesn't have enough in terms of reserves. They need China. China knows that. Tariff deadline. No deal is reached. U.S. tariffs could jump to 100% by mid-November. That'd be November 10th. China's controls on rare earths, meanwhile, threaten to disrupt global supply chains in autos, electronics, and military hardware. Both economies are already feeling the pain. Bilateral trade volume fell over 10% year over year, and China has redirected large volumes of exports to other regions. Their trade with the U.S. is down. Their trade with the rest of the world, based on their last numbers, because they're still producing numbers, up 8.3%. Other countries will say, we'll take it. We'll take it. That's fine. A U.S. reliance on China for key goods remains strong. Tech, clean energy, semiconductors, military supply chains are directly affected. China's rare earth monopoly and U.S. threats to further restrict imports and possibly curb exports of critical software remain major bargaining chips. Most likely outcome, both sides have signaled willingness to meet as soon as possible. This happens Saturday and Sunday in Malaysia with the pre-meeting group. Still high-level officials, but pre-meeting group. And then South Korea is, I believe, the 26th to November 1st. And that is a potential Xi and Trump meeting if the weekend goes well. While rhetoric remains heated, both recognize the massive cost of full-scale tariff escalation and strategic decoupling, which could destabilize financial markets in key industries. It would cause grief. It is enough, I think, to cause definitely a global slowdown, maybe even a recession. Given similar episodes in recent years, the pattern suggests the meeting will produce some form of face-saving compromise. I think that's a good assessment, such as delayed tariff hikes. I think that's probably table stakes there. Minor concessions on export controls. I think that's probably right. Or joint pledges to create working groups on key sectors. We pledge to continue talking, meaning we are not going to agree on anything soon. I also asked DeepThink to do something on this. This took DeepThink about 12 minutes. Here's the prompt. China and the U.S. are meeting in late October for trade talks. 90-day pause on tariffs ends November 10th. What is the current status of U.S.-China trade? What is at stake? Given the global status of each country, the assets they control, the resources they control, the imports and exports they need, and the modus operandi of each country's leadership, predict the most likely outcome of the trade talks. And 2, medium term, over the next 12 months to 35 months, medium term trade between U.S. and China. Which country has the edge? Okay, it's not long, so we can go through it here. Upcoming trade talks between U.S. and China, late October, set against a backdrop of acute economic brinkmanship. That's a nice way to put it. 90-day pause on tariffs due to expire November 10th. Recent escalations have transformed the negotiations into crisis management effort aimed at averting a catastrophic rupture in the world's most critical economic relationship. Current status. U.S.-China trade relationships characterized by managed antagonism and accelerating de-risking. While significant economic interdependence persists, strategic focus has shifted to national security, technological competition, and reducing vulnerabilities. The October crisis. The relative calm of the 90-day pause was shattered by a rapid escalation. October 9th, China weaponizes critical minerals. China announced extensive export controls on rare earths, lithium-ion batteries, and related technologies. Given China's dominance, roughly 90% of global rare earth processing, this directly threatens U.S. defense, electronics, and green energy supply chains. October 10th, the U.S. threatens embargo. U.S. retaliated by threatening an additional 100% tariff on all Chinese imports effective November 1st. And so it is November 1st, which is before the 90-day truce of November 10th. But maybe he's thinking, oh, well, China blinked first. This would bring total tariffs well into the triple digits, amounting to a virtual embargo. This tit for tat has brought the relationship to a crisis point. While officials indicate the talks will proceed, the atmosphere is volatile, with China vowing to fight to the end. The tech war. Underlying this trade dispute is a battle for technological supremacy. U.S. continues to enforce stringent export controls to deny China access to advanced semiconductors and manufacturing equipment. China is investing heavily in self-sufficiency and is using its critical mineral dominance as a direct countermeasure to the U.S. technology blockade. What is at stake? Global economic stability. If the threatened escalations are implemented, economists warn of a COVID-19 level shock. A full trade war would paralyze global supply chains, causing soaring inflation and likely trigger a deep global recession. Well, what do you do in a situation like that? A deep global recession, but soaring inflation. How do you get out of that? Lower rates to encourage growth, but what about inflation? Raise rates to kill inflation, but what about the global recession? That is an ugly, ugly place to be. Just the threat of being in that place should motivate the conversation in Malaysia and in Korea. Technological primacy. The core battle is over dominance in future technologies, AI, quantum computing, advanced manufacturing, which translates directly to economic and military power. The future of globalization. The conflict is accelerating the fragmentation of the global economy into competing blocks, challenging the rules-based international trading system and forcing a realignment of global alliances. Comparative analysis, assets, resources, and modus operandi. Global status. U.S. established superpower, strong network of global alliances. China, rising superpower, world's leading manufacturing hub, expanding influence via BRICS and the global south. Key assets and resources. U.S. is a global reserve currency. That's sort of being questioned again and again, right? Leadership in foundational innovation and advanced chip design. Energy independence, strong capital markets. That's all true. Near monopoly on critical mineral processing. Unmatched manufacturing scale. Leadership in battery and solar technology. That is all true. Key dependencies. Imports of manufactured goods and processed critical minerals. Imports of high-end semiconductor equipment, energy and raw materials, reliance on Western markets, and modus operandi. I think DeepThink got this spot on. U.S. transactional and prone to brinkmanship. The escalate to de-escalate strategy. Uses massive tariff threats as primary leverage. Focus on reshoring and friendshoring. I don't know about the friendshoring, but certainly the reshoring. China. State-directed capitalism, centralized, long-term strategic focus, prioritizes national security and self-sufficiency, willing to absorb short-term pain for strategic gain. Predictions, this is the most interesting part. The outcome, most likely outcome, tactical de-escalation and extension of the truce. I think that is probably where I would be. Kick the can down the road for 6 more months. Say that we're going to begin to talk. We're going to set up some joint committees. They're going to talk some things through. A grand bargain resolving fundamental issues is highly unlikely. Economic consequences of following through on the November deadlines represent mutually assured economic disruption. Recent threats are best understood as high-stakes maneuver to maximize leverage. The off-ramp. The talks will likely result in an agreement to delay both the 100% UF tariff and the most stringent aspects of China's critical mineral exports control. And if you believe that, the rare earth metals companies in the U.S. had one hell of a runoff, but they did pull back quite a bit. They could pull back much more. Extension of the pause. November 10th tariff pause will be extended, likely for another 6 to 12 months. 12 months, I think, is a little aggressive. Another 90 days makes no sense. 6 months, to me, seems like a reasonable thing. I'd probably be saying, yeah, 6 months probably sounds right. Minor concessions. China may offer increased purchases of U.S. agricultural goods and LNG, while the U.S. may offer minor tariff relief on non-strategic goods. You got to do something for the farmers. Soybean exports to China have basically just disappeared in favor of Argentina. And the U.S. is now helping Argentina out. Argentina's helping China out. Kind of a circular thing going on there, right? So if China says China needs soybean anyways, okay, look, we'll buy your soybean, but you got to do something on this other stuff, right? So we'll see what happens there, but I think that probably is what we can hope for, is some off ramp to make them both look good. Kick the can down the road for 6 months, get something going on the critical minerals, something going on the other side, but not a lot. And maybe it's done with China agreeing to buy something and the U.S. agreeing to a little bit. Medium term, late 26 to late 28. Most likely outcome, accelerated bifurcation and managed conflict. Near miss of October 25 will serve as a stark warning, supercharging the drive for self-sufficiency on both sides. Intensified de-risking. The crisis over rare earths will galvanize the U.S. and its allies to urgently invest in alternative mining and processing capabilities, though this will take years to scale. And I think if you add up you take the top 5 countries in terms of the reserves, and you add up the next 3, I think they just equal what China has. And then the amount of countries with reserves over 10 million tons, I think, is only 2 or 3 over 10 million tons, and it falls off very, very quickly after that. Canada has some, but not I think it's less than 1 million tons in reserve. Technological separation. The tech war will intensify. The world will increasingly operate on 2 distinct technology ecosystems. I think that's probably a good conclusion there. Persistent volatility. The relationship will be characterized by cycles of escalation and temporary truces. Tariffs and export controls will be normalized tools of foreign policy. New conflicts will likely emerge over Chinese industrial overcapacity, particularly in electric vehicles and legacy semiconductors. Who has the edge? In the short term, 0 to 12 months, China has the disruptive edge. China's control over critical minerals provides the ability to cause immediate, severe pain to Western manufacturing and defense industries. This gives Beijing significant leverage in the immediate negotiations. In the long term, the United States holds the strategic edge. Technological choke points. The U.S. and its allies control the essential intellectual property and equipment for leading-edge semiconductors. This remains China's greatest strategic vulnerability, in case you're wondering why the Netherlands is in there. ASML for lithography. They have a near monopoly on lithography. Innovation and alliances. U.S. economic system is more dynamic, and crucially, the U.S. can leverage a vast network of wealthy, technologically advanced allies to amplify pressure and develop alternatives. And systemic reliance. U.S. financial dominance, energy independence, robust economy provides a stronger foundation compared to China's significant internal headwinds, including debt, demographic decline, and a prolonged property crisis. Yeah, well, let's not say the West has no debt. The West has probably greater debt crisis right now than China, I would say. So I don't know that it sort of pegged that one right, but I agree with most of it, primarily because we have to trade what's right in front of us. I think this is really what we're looking at. Is you're going to get an extension of the tariff talks. I don't think you're going to get any major breakthrough. China may agree to buy a little bit more in terms of agriculture from the U.S. The U.S. will allow it a little bit more access to some kind of technology in exchange for rare earth, and each one will continue to go their own way, buy themselves some time and continue to go their own way. I think that's probably what would get. So if you're thinking soybean, you'd be thinking, well, what's the immediate thing? I should sell a put under maybe September soybean, September 2026. If China is going to buy more, that will support pricing. If China is not going to buy more, there'll be a smaller crop planted next year. So that should support pricing. Either way, it should support pricing. I think a put on soybean sort of makes sense. I don't know that I'd directionally trade it, but a put gives me some kind of flexibility on the downside. Rare earths, I wouldn't be buying any of those companies right now. I'd just be sitting back and waiting. And as far as this tension in the market, probably kicked down the road for another, well, let's just do it 6 months this time. Okay, let's move on to S&P 500. First, though, this just came through on Truth Social. Trump attacking Colombia. President Gustavo Petro of Colombia, well, this is a bold statement too, is an illegal drug leader, strongly encouraging the massive production of drugs in big and small fields all over Colombia. It has become the biggest business in Colombia by far, and Petro does nothing to stop it despite large-scale payments and subsidies from the USA that are nothing more than a long-term rip-off of America. They're ripping us off. As of today, these payments, and this is all caps, by the way, this sentence here. As of today, these payments or any other form of payment or subsidies will no longer be made to Colombia. And now the threat. The purpose of this drug production is the sale of massive amounts of product into the United States, causing death, destruction, and havoc. He doesn't say that the purpose of this drug production is to satisfy the insatiable demand from Americans, but if there was no demand, there'd be no supply. Petro, a low-rated and very unpopular leader, of course he is, with a fresh mouth towards America. You watch your fresh mouth, Sonny. A fresh mouth towards America better close up these killing fields immediately, or the United States will close them up for him, and it won't be done nicely. How do you think he ended this? Thank you for your attention to this matter. And another one just came through. I am interviewed by the great Maria Bartiromo right now on Fox News. Enjoy. So it's 10 o'clock. He's on Fox News with Maria Bartiromo. I should say the combination of Fox News and Maria Bartiromo is state TV. So he is being glorified on state TV right now if you want to tune in and bow down to dear leader. Anyways, let's get on with our business. S&P 500 forward four-quarter operating earnings 294 ended at 666.4.01. At one point in the day, it was 6666.66. Crazy stuff, huh? The amount of times we see the 666 together recently. Good thing there are no conspiracy theorists in this world to make something of the 666 that we keep seeing again and again and again. 22.64 times forward earnings. 22.3 last week, so the market is a little bit more expensive. All-time high, still sitting at the October 8th, 673.78. We're down 1.4% from that all-time high, with the volatility staying in place. IWM, October 15th, hit an all-time high, 250.33 on a closing basis. Intraday was higher. On a closing basis, ended at 243, down 2.76 from the 15th to the 17th in 2 days, 2.76. IJR still has not taken out its 126. Got up to 122, I think, on October 15th, 117.59. It's 7.2% below its 126. And triple Qs, October 8th, large cap did not hit all-time highs last week. Small caps did. Down 1.42, in line with the other large cap. The earnings this week, 89 versus 90. That's about as close as we're going to get. Implied volatility, last 16.4 on SPY. Gold's implied volatility is 10 points higher. Silver's implied volatility is 30 points higher. Last week, the only earnings vol I played was JB Hunt. I didn't like any of the other setups. The straddle was too thin. You know, suggested move on earnings 3.5%, 3.7%. I don't like those. Even though all of them, I think all of them would have won had I played them. I just didn't. The coming week, it's coming up, there's about 20 to 30 of them I've identified where I said, oh, I'm going to play those. I play very particular. I don't play them all with stops. I only play those I don't mind owning. And usually I never end up owning them, but I only play those that I do not mind owning, which makes it a low-risk trade for me, because if it does beat the straddle, hey, I don't mind owning it. And if it doesn't, I make money just by saying I wouldn't mind owning it. So I will be playing quite a few next week. I will be posting those in the Discord. For those that have the applied series, you'll be able to see what I'm setting up for. I'll post something around 3:30, 3:45, because you got to set up these trades as close to 4 o'clock as possible. Let's have a look at who's reporting. Okay, we'll start with Monday, and my usual disclaimer holds. I am simply just reading off a screen here. I didn't fact check any of these. They may be right, they may be wrong. It is what it is. Monday we have 2 before the bell, 2 after the bell. I'm not interested in any of those really. Tuesday we got some interesting ones coming up. So before the bell, if you're going to do any setups, you got to do them Monday before the close, because they do involve using options. And there is no pre-market for options. They don't open until 9:30. It's too late by then. So you got to do it the night before. General Motors. I will be doing something on General Motors. We have NASDAQ in here. General Electric. Halliburton, Coca-Cola, Lockheed Martin, Northrop Grumman, Pulte. All of these I'll be doing something on. They're all before the bell. All the way down to 3M. RTX I'll be doing something on. Pentair, 3M. Probably all of those. And then after the close, look at that. You got Netflix down there. Let's see what its spread looks like. Texas Instrument, I'll probably be doing something on. I'm not too interested in any of the others, however. Going into Wednesday, and again, you got to see who's reporting before the open. Ends at Northern Trust here. Boston Scientific, AT&T, definitely AT&T. Teledyne, I'll be doing something there as well. CME, most likely. You do have early in the week as well some regionals, or throughout the week some regionals. So let's see if there's any more credit stress out there. After the close, who have we got in here? Where is 4 o'clock? Crown Castle, First Energy, IBM, Kinder Morgan. I'll be doing something there. Lam Research, something there. And not really on Las Vegas Sands. O'Reilly Automotive, no. Packaging Corp of America, I'll probably be doing something there. Tesla, I'll be doing nothing there, but I do have a short on Tesla that is set up in such a way that my delta is very close to zero, but that I have great theta and Vega. Vega's going to crush me going into Wednesday. This is Wednesday after the close. Vega's going to hurt me. Those premiums are going to increase because it always increases before earnings. However, actually, no, let me take that back. The Vega I have is attached to the November options. It'll be this Friday's options where the implied volatility spikes. So I should be okay. All right. Let's go into Thursday, and let's see who's reporting in the morning, all the way down to West Pharmaceutical. Union Pacific, Norfolk Southern, I'll be doing something there. Blackstone, I don't think I'm going to touch. CBRE, I don't think so. Freeport, there's Freeport. I'll be doing something on Freeport, depending on where it goes. I mean, if it rallies to 48 before earnings, I don't think I'm going to touch it. But we will have an update on what's going on in Grasberg. Don't expect much from Freeport. They probably aren't going to do very well, and they'll probably guide to almost a nothing fourth quarter. Where's the expectation? Estimate 41 cents. Year ago 38. I don't know. Sort of think that their result would be, market reaction would be negative if it rallied in front, and probably positive if it sold off in front. Hasbro, Honeywell, I will be doing something on those. We have Southwest, P&G, PG&E. Poolcorp, that's an interesting one. It's held up fairly well, so I might do something there. Expectation 338. T-Mobile, not really. Tractor Supply, maybe on Tractor Supply. Valero, yes, I will. This is still in the morning, so that'll be a Wednesday setup. And then after the bell, Deckers, Digital Realty. This is DLR. Their data centers, a REIT for data centers. Intel, I won't be touching that. Newmont, I won't be touching that. Too far. It's gone way too much. Although I think it can continue to perform. Keep in mind, Newmont doesn't just have revenues, it has expenses, and it hasn't shown itself to be really great at its expenses. Ford, I'd rather do GM than Ford. I'd rather own GM than own Ford, so I'll pass on Ford most likely. Baker Hughes, I'll probably do something there. And let's go on a Friday. this should be all before the close. I very rarely do you see a Friday after the close unless they're trying to hide something from you. Illinois Toolworks might do something there. General Dynamics may be there. Healthcare I just avoid. And Procter & Gamble depends on their volatility, but I might do something there. Depends on what options are available. But there we are for the earnings. And good 20, 30 targets here for earnings vol. Okay, for our bottom up corner this week, Bloom Energy, BE. Last week I did Oklo. Asked if you guys liked it, and everyone did, or at least there was no comment saying please don't do any more of that stuff. I was asked to do certain companies, but some of the companies that were asked for are larger companies that are well covered. Don't need me for that. The ones that I want to focus on are ones that perhaps maybe we haven't heard of, but appear to be getting some kind of market momentum. So we sort of want to know what's going on there. My conclusion from Oklo last week was this is years away. I think the pricing is very premature on that particular company. For this one, for Bloom Energy, really high implied volatility, really high on the options, which makes it sort of attractive to look at to say there's some volatility here, but fundamentally there's something here. I think this could be the real deal. And if it is the real deal, I think you really do have to compare this with small nuclear reactors and say, well, what would be the point of SMR if this is the real deal? Do I have your attention yet? Let's go through it and see what we have. Look at this, up 1,100% in 1 year. Oh, this is a 1 year chart. This is about $10. They closed at 112.60 after breaching 125. Up 1,100% in one year. This big green bar here was the announcement October 15th. Brookfield up to a $5 billion deal with Bloom Energy. They are U.S. based. They refer to themselves as energy technology, not an energy company, not a technology company, but energy technology. They sell what is called Bloom Energy servers or Bloom boxes. They refer to them as these, which are modular energy production systems, on-site energy production systems. So let's have a look at, well, before we jump to their technology, look at their IV, 140%. 140%, you can get a lot done at 140%. You can get a lot done. I'm going to show you a few setups. September 30th, 17% short interest. That's why I think on October 14th with this announcement, why the price action was so violent to the upside is because everyone who was short was saying, ah, shit, this sucks. So it ran all the way to 125 before settling out at 112.60. That's a short squeeze. Not pleasant to be in, and not pleasant when you're the last one out. You get out at 125, you puke, you give up, you say, I give up, I'm out, and you watch it retreat to 112. Now you're upset twice. Once for the short squeeze, once for, oh, come on, I was the last one out. Turn off the lights. Their technology, SOFC, solid oxide fuel cell. They set up on site. These modular units are set up on site. Their electrical efficiency is 50 to 60%. We'll talk about electrical efficiency down here, but 50 to 60%. Nuclear is not there. Is not 50 to 60%. You have to get to combined cycle nat gas to get to 50 to 60%. So combined cycle, like if you have a nat gas plant, it produces electricity somewhere around 40%, 35 to 40%, somewhere in there. But it also produces a lot of heat. Combined cycle, let's say there's the heat. Combined cycle then grabs that heat and produces another stream of electricity with it. So you have one line of nat gas coming in. Simple cycle just turns into electricity and vents off the heat. Combined cycle takes the heat that's being vented off and produces another stream of electricity. You can get electrical efficiency 50 to 60% with combined cycle nat gas. So this is competitive. This fuel cell is competitive with combined cycle nat gas. No combustion. it's electrochemical. There is no combustion. It's a fuel cell. Whereas even combined cycle with this electrical efficiency is combustion. Check this out. This fuel cell can use nat gas as an input, biofuels as an input, or hydrogen as an input. This gets a little bit more exciting when we get to their electrolyzer. And they are behind the meter. What does that mean? Well, let's say that you have your building over here. Here's the street. Here's the electrical cable. Here's your meter, and off you go. You are in front of the meter. Behind the meter means you set up some kind of electricity production on site and supply it. You are behind the meter. So you are off grid. You don't rely on the utility at all. So you can have an always on system that no matter what happens to the grid, especially a grid powered with a lot of renewables, is volatile. Could go on and off. You can't have that for certain applications, such as data centers. It must be always on. And there it is, always on. And electrolyzers for green hydrogen. They can produce green hydrogen. So the output of these Bloom Energy servers can be captured and recycled in to produce hydrogen, which then can be used by the fuel cell, which produces output, which can be captured, which can be brought in to produce hydrogen, which can be used by these fuel cells, so you can capture the output. Do you see what I mean? You have this closed loop system. That's exciting. Not only that, if you are producing green hydrogen, you then have another revenue stream of credits. Let's look at electrical efficiency. This is useful electrical power output divided by the total energy input multiplied by 100. Hydroelectric is the best, 90%. So the region I'm in is powered by Niagara Falls hydroelectric, world leading in terms of energy or electrical efficiency. Combined cycle natural gas up to 64%. Simple cycle 33 to 43. Coal-fired is about 33 to 43. Nuclear, traditional nuclear, about 33%. Small nuclear reactors, this should be an N, not an M. Small nuclear reactors. Light water, 33 to 37. High temperature, 35 to 40. And molten salt, 37 to 41. This is all theoretical. Theoretically, high temperature, maybe up to 50. Still doesn't get to the 60%. We're going to test that, by the way. See if that's true. Hindenburg Research called it out, saying, no, there's no way that's not true. They're overstating their electrical efficiency. But we have numbers. We're going to find out if that's true or not. Okay, let's have a look at some fundamental stuff. With Oklo, there was no fundamentals to look at. They're pre-revenue, pre-commercialization. Bloom Energy is post-revenue, post-commercialization. So we have something that we can look at. Even though they're losing money, they're losing less and less each time. But we do have things to look at. Some good things, some not so good. And like any presentation, some things are simply just not mentioned, and other things that make them look great are highlighted. And if you've been through their statements and you're going line by line, sometimes they don't add up. You're looking, saying, well, why are you presenting it this way? How are you getting these numbers? Some of them I can't recover at all. Some exhibits, they'll mix GAAP and non-GAAP numbers together. They'll call it a summary of, and they'll mix GAAP and non-GAAP, and you're wondering, well, why are you doing this? So it is, the statements look like they're engineered for consumption. They're engineered to make you feel good about what you're doing. I don't think they need to do that, but there we are. Here's the revenue, their cost of revenue, and their gross profit. Over at the far side over here. So they break their revenue down into product, installation, service, electricity for their total revenue, and their cost of revenue is broken down that way as well. Have a look at service. 54 million. Cost 49.4 million. A year ago it was 52 million. The cost of that was 52 million. There's almost no margin in service. Last quarter was 53.5 million. Cost was 52.8. So service, I don't know that I'm too excited about their service at all. I'll just back up the crossouts because we don't want to cross them out. And if we look at installation, in each period, it cost more to install than the revenue that they got. 42.7 million last year. Cost 44.3 to install. Over here, 37.3 million in installation revenue, costs 38.2 million to install. I don't know that you'd purposely quote that type of installation unless the installation is meant to be a wash, saying, look, we'll install it for you on a cost plus system. Whatever it costs us, you'll pay. Just to get the modules in place, to get the electricity revenue in place. Maybe that's what they're doing. But they're certainly not making anything on installation, and service is minimal. So they're making it all on their product. Let's look at their gross margins just on product. And I have the three columns, the three numbers that match up with the three columns. This is the last quarter, 33%. A year ago, it was 28.7%. So they do tout gross margin improvement, but last quarter was 34.2. They say nothing quarter. They don't compare anything quarter over quarter. It's year over year. Quarter over quarter, it's down. Year over year, it's up. Let's look at electricity revenue here. Last year, 14.2. This year, 12.8. Last quarter, 26.9. Lower year over year on electricity revenue, 14.2 down to 12.8. Now that simply just could be because their input costs were lower, so their output, the value of what they were selling was lower. But if you have more of these boxes installed year over year, wouldn't you expect that the combined revenue for that would be higher, not lower? I don't have an answer for that. That's why I just have a question mark saying, well, what's going on there? Let's look at their gross margins. 26.7 for the last quarter. Last year was 20.4, and they do talk about it. This is how they talk about their gross margin. 26.7 second quarter 2025, increase of 6.3 percentage points compared to 20.4 in the second quarter of 2024. Non-GAAP was 28.2 versus 21.8, but they don't talk about last quarter. It was 27.2. Now it's 26.7. Gross margin was 34.2. Now it's 33. I mean, I could see it. We can see it, but they don't say anything about it. So that tells me that, look, they can see it. They've just chosen not to say anything about it. So I know that these statements are engineered for positive consumption, much like Palantir did. Try to find something bad in Palantir's report. It's all good. Well, we have Q3 on October 28th. Let's see what happens. We're going to watch gross margins for sure. We're going to, gross margins, and we're going to watch total gross profit. This is just gross margins from product. This is overall gross margins. Let's test their statement about 50 to 60% electrical efficiency, because we do have electricity revenue of 12.8 million, and we do have electricity costs of 7.7 million, and your input cost being whatever it is you're using, whether it be biofuel, whether it be natural gas, whatever the case is. If we look at simple cycle, and this is what we're looking at here, is you find utilities that run simple cycle and run combined cycle plants, and you look at their margin, right? Because in the electricity cost and electricity revenue, you could be talking about just different types of costs, different types of margins. So you have to look at what the margin would be, not just what the input cost is, because that could include a whole bunch of other stuff as well. Simple cycle, 65 to 80% is the cost as a percent of revenue. Fairly high because it has low electrical efficiency. Combined cycle is 50 to 65%, and their efficiency is 55 to 64%, right? And getting this efficiency, their cost of electricity as a percentage of their electricity revenue runs 50 to 65%, 60% in the last quarter. Last year was 65%. This quarter was 43%. Again, another question about what happened in this quarter that sort of made it look like a better company. But it seems to be within the 50 to 65% cost that you would expect combined cycle to be, and it's claiming to have the same electrical efficiency as combined cycle. It's not as high as 80%, which is simple cycle. So I don't know, on the surface, without really digging very deep on the surface, I don't see that they're lying. If they are, something would show up there, but it doesn't appear to be. Hindenburg questioned the efficiency, claimed it was overstated. I don't know. I'm not an expert on this, but just from a financial, just looking at it very quickly from a financial perspective, the costs are not running in a percentage that would make me say, yeah, I think they got something here. I'm looking at this saying, well, this is, if their claim was right, they should have a cost structure that looks like combined cycle nat gas. They do have a cost structure that looks like it, so no evidence here, right? Let's look at cash flow from operating activities. You have to be aware of this. Stock-based compensation, 3 months ended, 30 million. The previous quarter, 30 million. A year ago, 20 million. So it looks like they got a run rate of about 120 million. Their equity to common shareholders is about 600 million, and they got a run rate of 120 million in stock-based compensation. 20% of the equity to common shareholders is in equity-based compensation. Now, nothing really wrong with the equity-based compensation. What it says is that to get the quality of the people we need, we can either throw a whole lot of money at them or throw some equity at them. So we'll get them at competitive market rates and throw some equity at them. Otherwise, we're not going to get them. So if there was no stock-based compensation, their operating expenses would just be much higher because you'd have to throw money at these people to get them. Except for management, I'm sure that they're sharing a lot of that 120 million a year. Just be aware that there is a huge level of stock-based compensation, which, if they are successful, is a lot of future dilution. If you look at their equity, they do have losses. So looking at retained earnings, it is negative, meaning when they do turn profitable, they have a tax shield for a number of years, which should help the cash flow. And speaking of cash flow, they are a cash burn company right now. However, from a technological perspective, with what they're doing, it is here and now with revenue and proven. It is commercializable. They just need some scale now. This deal with Brookfield should help a lot. Whereas small nuclear reactors are still 5, 10, 15 years away. They're tomorrow. This is here and now. And their electrical efficiency is higher than what small nuclear reactors are with no combustion. No combustion. So if they do have this 5-year lead, where are they going to be in 5 years before nuclear even becomes a thing? I think they'll probably, if you play that out, could dominate to the point that you look at these nuclear companies and say, why would I want a small nuclear reactor when I can have one of these guys? You know, I haven't done the deep comparison between them in a whole bunch of in looking at a whole bunch of other possibilities. But I want on-site, always-on power, and I do care about the emissions. This seems to check all the boxes. Huge volatility, which means it would be a shame to let this go. Now, what I'm going to show you is I'm only going to show you with this one. There are trade setups on every company. I did a trade setup on Oklo to isolate its volatility as well. That one's paying nicely, by the way. And I'm going to do something on this one. Normally, I just reserve this for the applied level subscribers. Going forward, whatever company I highlight, this part here will be only for the applied level subscribers because, well, they pay for it, right? So let's see what we have here. I have the options chain up. This is 34 date expiration, November expiration, 34 as of Monday, because of course we're closed on the weekends. I'm highlighting the 80 and the 60 puts over here, and these are just puts. Here's the open interest, so you can see there's plenty of volume even at these levels. The volume during the day was rather light. This open interest probably is a residual of contracts that were done at lower prices. But let's look at some pullback ratios here. We're at 117.51. That was the 52-week high. On a closing basis, a 32 and a 50% pullback, 80 and 60. You might recognize these as being Fibonacci retracements. 80 and 60, she might say, well, my first entry would be at the 80, then at the 60. If this is something you want, it's something I would want. I wouldn't mind holding on to this, but not at the current prices. But at these prices, I would. So if I did a pair, one at the 80, one at the 60, if I paired them, it's 571 for each pair. Look how far out of the money I am, 80 to 60 over 34 days. And look at your statistics here. Here's your Vega and your Theta, and your Delta here is 15.5. What this Vega is telling you is that for every 1% drop in IV, this contract earns $8.90, and you have very elevated IV. And the Theta is telling you you earn $15.60 for every day that passes. So I'm thinking 5 and 5. If you do a pair of 5 and 5, it's equivalent to being long 100 shares, because you add the deltas. That's one pair. You get almost 20 on the delta multiplied by 5 contracts. That would be 1,000 shares. If this were all put to me, I'd be long 1,000. This is equivalent to being long 100. However, being long 100 with a Theta of 109 and a Vega of 60, long 100 shares gives you no Theta or Vega. Here I've got Theta of 109 and Vega of 60. So if we drop from 140% IV to 130% IV, this earns $600 of its premium just from the drop in IV. What's your margin? You're so far out of the money. Margin is $545 for each pair. And what is my break even? You have two break evens here. You have a break even on the 80 and on the 60, because it could drop to under 80 but over 60. The 80s would be put to you, but the 60s wouldn't. Your break even is 74.29. And if it drops below 60 and you allow them both to be put to you, your break even is 67.14. So the most I can risk is $67,140, because I'd be buying 1,000. Let's assume it drops to 0. Worst case scenario, 67,000. I can live with that. That's not a big deal. So for me, I'm comfortable with that setup. It doesn't go to 0 that quickly. Not after a big announcement with Brookfield like that. It's not. I don't even think it's going to 80. And I really doubt it's going to 60. So I'm going to use the options, the huge implied volatility, to make what I think is a no-brainer bet, is an easy, safe bet. Here is the structure of, or the skew, I should say, the structure of its volatility over strikes. Here's where we are right now, right here. The 34-date expiration straddle, by the way, just to show you how much is in here, this is the November. If you price out the straddle, it is 33% of the price, which means even if this moves against you, the IV is so big, it is not hard to work your way out of a problem. With this much IV, you should be able to work your way out of any problem in a couple of months. Which means it would be very difficult to lose money on this thing unless it goes to 0 within a week. It would be hard to lose money with this kind of IV. 33%. Straddle is $3,700. That's incredible, right? This is the statistics on the straddle. A delta of negative 0.22, Vega of 0.27, Theta of 0.53. This is telling you $27 for every 1% drop in IV, and Theta of $53 a day on the straddle. What is we'll get to what is your hedge here, and we'll get to a spread here shortly. Where's your risk? Your risk is the price starts moving down. It doesn't have to go to 80. If the price starts moving down, your margin requirement starts moving up. which means you're going to need liquidity. Your initial margin's only 545, but if this drops another 10 bucks to 107, still well above the 80 and the 60. But the difference between the strike and the stock price, as that shrinks, your margin requirement will go up. So you have to think about your maximum margin. Well, your maximum margin is going to be your strike price minus what you got paid. So for me, the maximum margin is going to hit at 67,140. That means the stock is at zero. And the maximum margin I would need is 67,140. So as long as I say, well, listen, worst case scenario, I lose that much, I would have to have that much liquidity. I do. I'm good with that. As long as I'm good with that. If the loss is too big, I would resize. If I say, oh, I don't want to lose 67,000, I don't mind losing half of that, then I would resize either 2 contracts or 3 contracts, but not 5. I would just resize. So if you think about your size, how much should I take? Think about your worst case scenario, and then figure out how much you would lose. If you're comfortable with that, then you'd say, okay, that's fine. I'm comfortable owning it all at $67.14 and being long 1,000 shares. Why? Because I got 140% IV. I can work my way out of any problem with that kind of IV. You know, this is not ownership is not a problem. Lack of ownership would be the problem. So I have no issue with this. But let's say that you say, well, I don't like this idea that as it starts coming down, my margin's going to increase. I'd like to know what the maximum is, and I'd like it to be small. Do a spread. Sell the 80, buy the 60. It's $400 in premium that you get. Instead of $571 by selling both, you get $400. Your Vega per day is 57. For every 1% is 57. Your theta is 94. Maximum margin is 16. So where do I get the 57? It's the 89 minus the 32. That gives you a 0.057. 57, $5.70. Sorry about that. $5.70. You're probably going, 57? The guy's smoking something. $5.70. Sorry, I did the same problem here. $9.40. Here it's 0.156 minus 0.062. Oh, hang on. No, I did it right. This is per spread. I would be doing more spreads, that's all. I whenever I do things, especially a spread, I would do 10 at a time. 10 is sort of my minimum on things. So that's why it would have been that high for me. So maximum margin 1,600 for you. That would be maximum margin between $80 and $60 is for 100 shares is 2,000. You got 400 per contract. So yeah. You'd be capped at a maximum of 1,600 as opposed to maybe going higher. So you can do a spread. I'm going to do this one over here. These 2 5s. Normally, I don't really do a lot of risky trades like this on high vol stocks for the simple reason is I may not want to own them. These, if they are put to me, I don't mind owning Bloom Energy. I don't want to own it at 117. I want to own it at 67, which is, some 45% lower than where it is. I don't think I'm going to get to own it at 67. And if I don't get to own it at 67, why not make some money doing it, right? So this 5 times 571. We'll see where it opens Monday. I may not have the chance to do anything Monday, but I'll set it up such that that I do have some kind of trade on this one. Cannot let this go. This 139.5. This is 2 weeks ago. It was at 121. The deal with Brookfield pushed it up. So as this starts settling in, as the market starts recognizing that the fundamentals are moving up on this stock, it will bring the volatility down. So being short Vega on this one is a no-brainer. You should be short Vega on this one. Trying to get an isolated short Vega position is the challenge, but if you are comfortable with Delta at a much lower price, being short Vega is an easy thing to figure out. And that is Bloom Energy.